Welcome, everyone. We are pleased to host the Turkey launch of the UNCTAD Trade and Development Report for the second consecutive year with Dr. Anastasia Nesvetailova, Head of the Macroeconomic and Development Policies Branch at UNCTAD. Welcome, Anastasia. It is always a great pleasure to have you in our events.
My pleasure, dear Serkan. Thank you for having me and thank you for giving the opportunity to launch the report with you.
Thank you so much. As 2025 draws to a close, the year has unfolded as an unprecedented whirlwind, from which we believe valuable lessons have been drawn, and offering a deeper understanding on how politics and economy can evolve together and at times and collide with one another. And meanwhile, UNCTAD has been closely monitoring these developments and always keeping us informed in great detail on how trade and investment are faring in these volatile circumstances. So we really appreciate your expertise on that area and all the reports that you are preparing for the global good and informing us. They are our key instruments to understand what is going on. And based on those, today's webcast takes place in this tough times in which we will explore how the global economy is responding to geopolitical tensions, tariff escalations, increasing protectionism, uneven and constrained access to finance, and imminent climate crisis as one of the areas that we are deeply involved in. But without further ado, I would like to introduce YASET's Honorable Chairperson, Mr. Tolga Demirözü, and hand the floor to him for his opening remarks. Tolga Bey, welcome.
Thank you very much, Serkan. Thank you very much for the great opening. And I'm very happy to again welcome Dr. Nesvetailova for today for this great report. And I would like to also welcome everyone, esteemed colleagues and partners for joining this event. We are very excited and to see the first highlights of the key finding and the insight. This is always very much inspiring for us, for our work and the things that we are doing. So I would like to again welcome Dr. Nesvetailova, Head of Macroeconomics and Development Policies Branch and UNCTAD. And also together with her team, she's doing a great report, a flagship report for the trade and development as well. And as Yas said, we highly value the views and opinions from senior experts from international organizations that reflects a diversity of the perspectives for us, and which we are also very much using as a guiding reference in articulating our association's narrative and as well as while conducting policy advocacies. Also, this year, 2025, is another turbulent year and marked by the policy uncertainty at the high level. And at the same time, we see the trade wars, regional tensions, ongoing conflicts. But on the other side, you also see that the global trade proven resilient, continuing to grow against all odds. So that's also another interesting and a challenging year. Yes, we are coming towards the end of the 2025. That was also another year to be discussed and analyzed. And as Yas said, I can proud to state that we are strongly supporting sustainable development goals and the green transition towards more climate resilient future, and also using our network capabilities to support these initiatives. And of course, on the other side, Turkey and the European Union relationship is staying at the top of our agenda. And we also see that there's an increasing level of the dependencies between two partners, two strategic partners. And we do also believe that Turkey can play a key partner role in achieving EU's decarbonization targets. And also this year, there has been some important developments in Turkey, such as pushing strongly the nationwide emissions trading system and also the other laws and regulations regarding about the climate neutrality. Having said that, as you are very much excited to hear the upcoming report and the details, I would like to again thank you very much, UNCTAD and Dr. Nesvetailova for all participation, for all her attention and support. And we are very much looking forward to hearing this inspiring and very interesting report in upcoming time. Thank you.
Tolga Bey, thank you so much for your valuable remarks. And now, Anastasia, we are delighted to have you back for another UNCTAD webcast. We are aware that you and your team worked extended hours to address all these demanding agendas throughout the year, and you are on a long journey of presenting the report. And again, thank you very much for sparing time to be with us today. Let's switch to the report. Could you share the report's key messages to us, and then we can comment on what is ahead and what has been happening?
Very gladly, dear Serkan. Thank you, Chairman, for the introduction. Just to confirm, can you hear me okay?
Perfect.
Perfect. Thank you very much. So indeed, it's been a difficult year also commenting and analyzing the trends, simply because of volatility and many questions that are unfolding in real time. So we call this report On the Brink. And the idea is to, or has been to understand really how in all the challenges and shifts that are colliding in time and space, how resilient are the developing economies to complex overlapping shocks, climate emergencies, policy shifts, new uncertainties, and of course, the structural issues that haven't been resolved as yet for the global south. So this was, if you want, our key research question this year. And we approached it from two major premises. On the one hand, as you may remember from my last year's presentation, we approach it from a more historical stance of putting today's context, this particular year, 2025, in a longer term historical transition. And the chart on your left, so it's figure 8, the fifth growth wave. It's one of those elements that we discussed last year. It's the rise, the emergence, the evolution of a new growth wave in capitalism, or new type of capitalism, if you want. It's a Schumpeterian understanding of how various factors that shape an economic structure for a durable time, technology, finance, the nature of exports, key connectivity, transport systems, the nature of export markets, again, mass technologies that shape us as consumers and producers, how they change over time. And if you do remember, last year, our report basically concluded that we are now entering into a new growth wave, post-industrial, if you want, or post-financial capitalism, which is fundamentally different in its energy sources. So it's a transition to new green or environmentally friendly types of energy. Overall green transition, emergence of revolutionary technologies such as AI, but also synthetic materials, new biotype of bioengineering. And in one of the most important features of this new growth regime or new growth wave is the slowing of world manufactured and merchandise trade in relationship to the world GDP. So this graph that you see, the snake line on the left, captures the slowing of manufactured trade since about the time of the financial crisis in its relationship to the trend of GDP growth. And you can see that the volatility in trade, the new uncertainties, and the restriction to export markets that a lot of developing countries are now facing is not only a current problem. It's been unfolding, and it's been a historical trend. To us, it signifies longer-term transformation of capitalism. And that is one of the main challenges that goes beyond the context of simply year 2025. At the same time, this is not to deny that 2025 has been an easy year, but what is happening towards the end, and your questions and comments already capture that, is that the uncertainty of early this year has now normalized as policy volatility. So we know that there is major shift and major reshaping of trade regime, trade policies, trade measures. Many of them go beyond trade. They go for tariffs, for taxation, for labor markets, for industrial support, for screening of investment programs in major countries. But this is now not simply an uncertainty where you don't know which factors even to consider. This is now an environment of policy volatility that is going to continue into the next year, most likely. So you can see from the capture in the graph that we are a little bit descended from the heights of policy uncertainty in spring, but we're still very high. We're, for example, higher than we were in the time of global financial crisis in 2008, and we're higher than we were during COVID. So this is all a very volatile context externally and challenging context historically. Let's do the next slide. So in this volatile context, there is an apparent resilience to growth. We see that this year, world economy is likely to finish with a 2.6% growth in 2025. And this particular figure is likely to emerge also in 2026. So we are stabilizing at just above the recession threshold for us in UNCTAD. So a recession threshold for us is 2.5 globally. So we're just a little bit above it. But you can see that if you consider all major economic centers of the world, advanced, developing, global south, we are lower than we were between the financial crisis and COVID, and we're certainly lower than we were before the financial crisis than we were in the era of hyperglobalization. So it's a weaker, stalling growth that affects everybody, but is particularly challenging for countries of the global south that do need aggregate demand, that do need markets to function, that do need access to export facilities, and they do need trade and other other connections with other economic partners. So overall, it's a transition to a low growth cycle, if you want to put it in cyclical terms. It's a low cycle of growth with very weak foundations, that the current uncertainty and questions over the future are not resolving in any positive way. In terms of resilience of the global south specifically, we have learned many things this year, and for the first time we presented macroeconomic global data to capture the resilience, the systemic position of developing countries globally. So, for example, we have learned for sure, and we see evidence now, if faced with policy uncertainty, with tariff shocks, with shifting trade policies of major advanced countries, developing countries are much better positioned today to withstand those shocks. So the network graph on your right, so the pretty circles, captures the metrics of global trade relationships between 2007 and the latest we could get data for, I think it's 2024. The yellow circles signify developing countries, so countries of the global south. And you can see very visibly how much more diverse, how much more matrix-like the system of bilateral trade relationships have become. So from a very centralized and kind of focused on key advanced economies in 2007. So this is we're not talking about the 90s, we're talking about the height of hyperglobalization. Back then, basically, there were a few emerging markets, China, and a dominant position of advanced economies shaping the world system of trade. Today, this system of trade has become very different. The participation of developing countries has increased almost twofold. And I'm happy to say that Turkey is one of the hubs that emerged as a global significant import-export hub internationally. So it's no longer a very northern-centered system. It's a system that really has become much more diverse and much more diversified, with China playing a key role, but not only. It's remarkable that a lot of economies from developing countries that made it into this global matrix are Asian. It denotes the connectivity of value chains, the integration of markets. There is less footprint from the economies of Africa, for example. But it's quite a remarkable transformation. It is even more remarkable when we look at the contributions to growth by region. So on the bar chart on the left, you see contributions to growth, so to the GDP expansion this year, which is feeble, but still there is a force that drives it. And you can see that almost 70% of that growth this year is coming from the developing nations. It's quite remarkable, especially if you consider the proportionate decrease of, for example, European contribution to this growth historically, and a relatively static role of the United States, for example, of North America as a major power. So this is one key structural factor that can explain the resilience of trade. It's the rise of the developing nations, the expansion of their trade linkages and trade relationships globally, but also with each other. So that has helped this year tremendously. On the other hand, and this is where I come to our second supposition in this report, we understand that in complex times, and times really defined by financialization most frequently, most dominantly, trade is not only about trade. In order to trade, you need first to borrow. Usually you raise capital in order to produce something, and then you engage in a series of financial, banking, insurance, hedging relationships simply to facilitate your trade, your import and export. So trade is always a financial operation, first and foremost. So this was our second conceptual pillar in this report. We looked at trade as a financialized system, or if you want, at a global trade finance nexus as an area of resilience, or as a perspective of resilience. We know that around 90% of international trade depends on global banking and financial infrastructure. We know that global macroeconomic contexts, and in particular financial markets, transmit shocks first and foremost. So any uncertainty, any change in investor anticipation, any mood swing, or any currency uncertainty, before it goes to trade, it is transmitted, it immediately is manifest in the financial market. We also discovered this year that there is a very close correlation between the international trade and financial cycle. Financial cycle is defined as monetary policies of advanced economies, the factors that shape monetary regimes, the role of the dollar, and its position, and investor sentiment. The idea of the financial cycle comes from the literature from back in 2000s. It's usually used in relationship to business cycles, or sometimes to political cycle. And it's the first time we try to trace the relationship between the two, the trading system and the financial cycle. And as you can see from the chart, really, it's a very close dynamic with financial factors really shaping trade outcomes and real economic factors. Some countries are much more exposed to this. Commodity exporters are one, but on the other hand, we also see that exporters of complex manufactured stuff are also exposed to financial volatility, probably because of complexification of value chains. Forgive me this horrible word. It probably doesn't exist, but that's what we can probably most accurately capture. It is still a hypothesis and something to be investigated much more closely further on. So in fact, any analysis or any of your insights as business community, as investors, as think tanks on the relationship between the two in Turkey would be most valuable. So with this complex system of trade, with the financialization of trade, we see very specific risk to resilience coming from this year, but also historically. On the one hand, we know that resilience of trade statistically this year came from front loading of many orders. And the chart on the left just captures the dynamic of imports into the US that anticipated or tried to anticipate a lot of tariffs to be introduced. And that partly explains the dynamism of trade flows and market resilience so far. We do not see it being continued into 2026. We already see some slowdown in sectors. Other observers see some inflationary trends in some segments of markets, and investor sentiment is turning away from longer-term commitments to financial opportunities offered by financial markets. Speaking of which, on the right-hand side of the slide, you see just how much the relationship, the gap, or the gulf between the outstanding volume of stocks vis-a-vis GDP internationally you have now historically. And if you can see just how high the yellow line, so it's the combination of outstanding values of equities and corporate bonds. Importantly, it doesn't include public bonds. It's not government bonds. It will be quite a different story. But even on these private market instruments, we are quite ahead and much higher than we were in the global financial crisis and other episodes of financial volatility before. In many ways, you can say we are overdue for a sharp financial correction that is likely to have real economic and trade impact, of course. We looked into a very specific dimension of these risks and these evolutions in the area of commodity trade. We looked into the financialization of food trading. We simply continued our early exploration of what does it mean that trade is now a financial issue, and we looked into the large monopolies that control food system internationally. First of all, we know that overall pricing of commodities, and in particular of food, increasingly are shaped. They're no longer a physical entity. It's no longer about supply and demand. They're shaped by financial instruments, by derivatives that are traded internationally. And although agriculture derivatives are still a small portion of all financial instruments internationally, it is their dynamics that affect prices of food, distribution of food, the risks of food, and ultimately food security for developing countries. Importantly, too, the role of over-the-counter products, specifically traded in Europe, continues to be high and important, and they continue to be really unmonitored in terms of being regulated platforms. So the majority of regulated exchanges on the graph come from Asia and North America, with Europe being a very thin slice of all this global universe of financial products. But what's important is that despite post-financial crisis regulations, there still remain over-the-counter trades where risks are often concealed. Part of the problem related to this is that we have traced how major food companies have not only become subject to financial factors, they are now active participants in financial markets and capital markets. They developed sophisticated networks of securitization, of using structured credit to compensate for thinning trade credit and trade finance that can facilitate food trading. For developing countries without sophisticated capital markets, without developed financial systems, this exposes them to companies which are financialized from inside. They are now not really financial companies, food trading companies as such. They have de facto become shadow banks. So for the firms that are listed on the right of this slide, we have established that more than 75% of their income structure now comes from operations with derivatives. There is a particular derivative scheme or instrument that is being used to shape their income and revenue structure. It's called embedded derivative. And it's a fascinating financial opportunity to benefit from both physical and financial, but also climate information about the markets. So one of the lessons of the huge finance-driven transformation of commodity trade is that there are now commodity traders are active participants of capital market. They do incur risks. They are full of liabilities and therefore debts. And at the moment, no systemic regulator is looking at these developments fully or comprehensively. May I remind you that there was a very similar situation in 2005, 2006, when a lot of mortgage providers and banks were engaging with securitization and structured credit, and it was considered to be okay because there were supposed to be regulating themselves very well. Well, they didn't. We see some echoes with this current evolution of commodity trading and subprime market back then. Overall, for developing countries, the situation of shocks and overlapping emergencies is complex because price volatility, financial volatility, and now climate costs combine to add to structural vulnerabilities. Traditionally, we know just how much higher the financial exposure of developing countries is to financial volatility. You can see it very visually on the chart below. But also, should you want to manage your financial policy space, should you want to become a proactive participant in capital markets, it's much more expensive for developing countries to borrow. So the chart on the right documents simply the qualitative difference of how much more expensive it is to raise capital, to borrow, even in national currencies, not necessarily in dollars, but even in national currencies for large emerging markets. So for the large emerging markets over there, are all G20 economies. I think Turkey is included. And if you consider the borrowing costs of advanced economies vis-a-vis developing economies, the contrast is very visual and stark. There are new challenges adding to these structural concerns. First of all, there is a rise, the so-called, another horrible word, servicification of the economy, or the rise of the economy of services. The rise of digital technologies and digital economy, and increasing investment in intangible assets. They do deepen the north-south wealth divide. I think it's related to the rise of this new growth wave, to the sixth industrial revolution, if you want, when we are moving from industry-based manufacturing to an economy where intangible capital, intangible assets, something called weightless economy, the economy of services that is called services partly because we don't know where to put these categories in terms of existing macroeconomic statistics. They do play an increasingly large role in shaping investment and trade patterns, but also trade profiles. In these economy of services, developing countries still are marginal. They control less than 30% of global services trade. And the growth or the contribution from the global south is mainly shaped by India and China, as captured on the bar chart on the left. So 10% of that services growth from the developing countries is mainly by two large economies. At the same time, and this is one of the big messages of the report, if you try to see the financial footprint of developing countries of the global south between 2007 and 2023, it's a very different picture to the diversified system of trade. Global south remains very marginal in the global network of finance. Global finance is increasingly centralized. It is prohibitive in many costs and many barriers to entry, many barriers to financial access, financial depth, financial integration. And developing countries are really barely present in this particular network. So the trade integration is really not matched by the financial integration globally for the global south. In fact, we see that the reliance on the dollar as a global financial anchor has actually increased with the diversification of developing countries. That's one of the more stark findings of this particular study. Let's look at Turkey. So on the one hand, it's a robust performance this year. It's above growth rate globally. It's at 3.3% for 2025. In terms of counterparty exposure risk, and direct bank exposures, this is the findings from our financialization of food commodities. And these are relatively moderate, relatively benign indicators. So there are some countries where exposure to bank relationship through food trading, through financialized food trading, can be up to 100%. So you see that in Turkey, it's actually very more or less well managed. We see that diversity trade index in terms of trade partnerships, in terms of countries that Turkey is trading with, is actually quite high, is 2.6% in our study, whereas diversity index of trade products is a little bit less at just under 1%. But it's one of the more diversified developing economies, as I'm sure you all know. Interestingly, too, and this speaks to the points that I just made a few minutes ago, it's still very expensive for Turkey to borrow internationally as a country, as a sovereign. So it pays on average about 16% globally to try to raise capital internationally. Growth is projected to expand somewhat in 2026 to 3.5%. And interestingly, along with Brazil, China, and Mexico, Turkey is one of the few developing economies that managed to augment the global financial network. Overall, this global financial system is increasingly geared towards international financial centers, mainly in the global north. So overall, a more or less resilient picture for Turkey, mainly due to macroeconomic measures and trade diversification that has paralleled trade integration globally. It is not really the same for overall the global south. For the global south overall, we see a very uneven rise between trade, production, and finance on the other hand. So on the one hand, we see almost 50% of share of world GDP and world trade now it's accounted by the developing countries. It's even more so in terms of FDI inflows. It's more than 58% at the last count in 2024. But you can see that as a share of global financial market, developing countries have not only not expanded, but they have decreased since 2007. And that structural, this big gap, I think, points to much more structural trend or problem or gap or transformation of global economy that is yet to be analyzed. Maybe it is to do with the financial investment in AI. Maybe it is to do with the role of kind of new types of capital that are using capital markets to drive company capitalization, to drive investment in new industries and not really in production and manufacturing. But it's really a very stark result. At the same time, we also established that in paralleling this marginal diversification in financial integration, the dollar has not only preserved its status as a global currency, but in many ways it has increased its role as a global financial anchor. So across the several functions listed on the bar chart on the right, the dollar remains very much a global asset, a global financial anchor where trade relationships, investment calculations, financial trades, production, hedging, derivatives, it's still going into dollar-based instruments, including, of course, sovereign bonds. One of the lessons, one of the dilemmas that stems from this more structural sweep is that there is now a dilemma of diversification as a policy tool. We see evidence how diversification in trade helps countries withstand massive shocks. It certainly works. It works for internal macroeconomy, for inclusive growth, and it works for systemic resilience internationally. But we do warn that in finance, once you consider the monetary and financial system, diversification can lead to fracture. It can increase costs. It can increase risks of illicit finance. It can increase disruption. So we do warn against a proliferation of new or smaller payment systems. They need to be approached very strategically and in a very integrated way to link financial integration, monetary integration with trade integration, for example, through regional capital markets, regional development banks. So simply to withdraw, in the face of a shock, simply to withdraw to your individual, unit of payment, it's not that simple, and it should not be a straightforward policy option at all. And I'm almost finishing. So we call, of course, for avoiding fragmentation. We call for a revised multilateral system. We opted, following Antonio Guterres' speech, we call for a networked multilateralism. So not a universally based model, but something that capitalizes on the variety of networks and hubs that now define regional economic centers, for example. We conclude that trade and financial systems are now deeply integrated, so they need to be approached as an integrated whole in policy and regulatory and multilateral measures. This affects not only macroeconomic context, but issues such as food security and environmental security, and of course technological security too. While developing countries now have power global trade and to an extent global production systems, they remain severely constrained by concentrated finance globally, concentrated dollar-based finance. And therefore, macro-financial development and climate strategies need to address these complexities together. So in practical implementation, policy proposals or policy tools developed for one area need to take account into what is happening in a different segment of the economy, or if you want bluntly, in a different ministry. And finally, we call for very simple, our calls for actual measures or actual areas of specific focus are very simple. We call for better and more available data. We call for more communication across various levels of policymaking, nationally and internationally, and we call for policy coordination. So through these three general principles, I think there is now a potential and should be political will to address all sorts of overlapping crises. And specifically, we looked at climate finance nexus, at measures to build climate resilience, at the trade finance divide that needs to be bridged to allow developing countries better and more inclusive role in global economy. And we do want probably more immediately to, we call upon regulators to start addressing shadow banking risks because the shadow banking system, by recent calculation, is now half of world finance. About 50% of world finance is now about non-bank financial intermediation. So it's a massive area. It's an area that continues to expand, and it's an area where developing countries increasingly play a larger role. So with this, I thank you for being again so attentive and wonderful, and I'm looking forward to your questions.
Anastasia, thank you so much. We do appreciate this holistic perspective of UNCTAD, seeing the world as a whole with all the developing and developed aspects. And it is really good to hear from your research and also from Secretary General Ms. Rebecca Greenspan's speeches, pointing out the importance of the finance and trade, the impact of finance on trade, and the share of the developing world in the future of the world. We are also noticing, starting from the COVID times, we started contemplating about how the global value chains, the global supply chains are changing. And the factors that we were always looking in were strategy, the costs, the security, proximity. Now you are bringing a much important and sometimes bringing a risky approach to these events, the finance aspect of it. So thank you very much for pointing this out. Whenever we look at the data, the historical data, whenever we see some downs or risks higher than the one we experienced in COVID times, it really worries us. And we also see that this limitation in finance or winning more in finance than the original operations is a risk in the future of the FDI. It is limiting companies and it's limiting their appetite. So after stating these things that are also important for us, maybe it would be beneficial for us to start with the mood. Like the global trade has grown in 2025, at least as suggested by the latest data. But I think it was better than we expected because we remember before we entered the summer, everything was at higher jeopardy. And it was really hard for us to understand what is going on and where things will end. So it is really hard to say or comment when we see the potential of the world to create crisis. Can we say that the worst of the storm is behind us and that 2026 may mark a more favorable year for trade and investment if we can address all the risks that you pointed out in your report?
Tricky question, Serkan. Thank you. That's why I pointed specifically in one of my slides into normalization of policy volatility. So volatility can be advantageous to many people who want to speculate or to anticipate some financial gain. There is always somebody who will win. But overall, your audience are key investors, they're business people. I don't think policy volatility can be conducive to long-term commitment of, to employment, to labor, to investment, to real structural shift. So unfortunately, also statistically, we see that, of course, there's been resilience of trade this year. Part of it is about this anticipation of higher tariffs or further policy shocks. So it's about front loading, but it's also about the investment associated with the financial boom in the AI technologies and other very specific and very select few companies. Outside of that, there's been very little momentum and dynamism. So when we detrend, when we take out all these kind of, let's call them frothy factors or very conjectural factors of this year, in fact, global trade growth decreases from about 4% that we see statistically at the moment to a much more normal 2.5–3%. So it's not a collapse, but it's also not a strong footing for next year, 2026. We do expect, in fact, a slowdown, and the macroeconomic slowdown of growth in major economies can be a crucial factor in slowing trade positions and trade profiles. Having said that, the services trade remains robust and dynamic, and South-South trade is again set to outperform global trade growth. So at the moment, we see about 7% growth in South-South trade, which is higher than growth average. So to answer your question, I think we need to be cautious. This resilience marks a lot of weaknesses, a lot of fragilities. But it's true that, as Rebecca Greenspan says, the worst case scenario of 2025 has been avoided.
That is correct.
And so in that respect, we have some optimism looking into 2026, but it's an optimism with a very, very serious caution.
Thank you so much. And during your presentation, you also touched upon the green aspect of investments and trade and the access of the developing countries to the green finance to facilitate their investments and production opportunities. Mobilizing concessional finance could help the acceleration of this climate change mitigation and all other efforts of the developing countries, but we always face up with a limitation in accessing the finance. And especially for the developing countries, the money is there. At some aspect, it is pooling, but the access is remarkably low for the developing countries. In line with all other financial limitations that we are experiencing in the global south, what would you recommend to these countries to secure a larger share of the green finance, particularly the project-based financing that increasingly seeking opportunities in the new destinations?
Excellent question, and thank you for this. My answer would be not specific to green finance, but very general to financial integration. We see that the structural challenge of having financial access, developed financial infrastructure, the depth of capital and financial markets is so immense for the global south that individually countries can achieve very, very limited success. They need to integrate regionally and sometimes even interregionally, but it's a taller challenge. And this would be probably the most effective way to get access to external finance, including for green transition, but also to develop your own deeper capital markets and financial instruments suitable for your economic needs and for sustainable development and climate resilience. Because individually, emerging markets, they tend to be seen as arbitrage opportunities for global investors. That's the way portfolios and strategies are structured. So I think integration, consistent, careful, balanced, systemic is the only way forward. The lessons of the European Union are interesting because they're still trying to build their own capital market. But it's also interesting to see what is happening, what will be happening to these initiatives in the next few years to come, because I think this year opened an opportunity and a need for that.
Mm-hmm. Thank you so much. And while answering this question, you also answered the next one, the inclination toward friendshoring and nearshoring among leading economies. When it comes to FDI, we also observe that it is focused. The numbers are increasing, but it is focused. And for some technologies, high-tech areas, they are focused in the developed countries. So this is also showing us uneven development that we need to address in the futures. So we also observe the intergroup trade dependencies, just like you pointed out. How do you interpret in a broader context that the global trade is reconfiguring?
Could you please repeat your question?
Sure. How do you see that with all these formation of the new hubs or formation of the new alliances or formation of the new networks? How do you, in a broader context, see the progress of the global trade? How it is reconfiguring? What are the other trends that we should be ready to align with the incoming risks that we need to address?
Complex question. I think this will be not only the next report, but a few other reports in the future. What we do see, and our chapter 2 in this particular trade and development report covers, we actually see a slowdown of friendshoring this particular few months. So it could be a reflection of overall subdued attitude to new projects and new investments. But it could be that investors and companies are trying to reconfigure supply and value chains in a more long-term setting. Structurally, I'm afraid there is a lot to be investigated about the rise, the kind of the two economies, the two level economies, or the two dimensions of two economies. One that is increasingly sophisticated, increasingly intangible, increasingly financialized, and increasingly less manufactured based. Again, AI investment, all the financial indicators that we see now, valuations of these massive techno giants from the global north is one indicator. At the same time, the developing countries, in one of our chapters, we have a comparison of which companies are now in the top world, top 10 companies for global north and top 10 companies for the global south. And it shows, on the one hand, a stark contrast between very technology-driven, technology kind of dominated picture from the advanced economy. So out of 10 companies, I think 7 are techno giants. And a very different profile of companies that are capitalized from the global south, which tend to be either banks or energy companies, or in one or two cases, actually telecommunication manufacturing companies. And that difference shows, on the one hand, yes, the structural disadvantage of developing countries not having the financial base for capital formation. But on the other hand, it also shows interdependence, and very tight interdependence, because without the exports from either energy exporters or production companies from the developing countries, tech giants in the global north would not be able to be so rich and so successful and so well capitalized. So I don't know if I'm answering it very coherently, but I think we are in the beginning of a very interesting process of new dimensions of trade financial integration. I don't want to say bifurcation, but it's certainly there are several dimensions now, and it looks like they will be much more structurally defined going forward if we avoid a massive economic correction.
Anastasia, thank you very much. The analysis of trends is always a major policy input, and how the countries and also the companies are reacting to it, and what we should reflect in our daily operations. That's really important for us. So thank you very much. Like, we are going to read the report in all detail, and there's one point that we can also provide feedback on you about the Turkish perspective between the finance and trade. How we are perceiving it, how we are reacting to it, and whether they are forming limitations in our operations, like you stated in some of your analysis. That will be also valuable for us to deliberate with you. And thank you so much for this great work, and thank you to the team also. Please carry our thanks to them. And before we close up, I would give the floor to our chairperson again, Tolga Bey, to receive his final comments about the issue at hand. Thank you very much, Anastasia.
Pleasure.
Thank you. And with the gratitude and the reflection, we would like to close this session by sincerely thanking to Dr. Nesvatalova for the clarity and the insight, and also the inspiration shared with us. I think and I believe that every and each one of us will go into deep dive analysis for this inspiring report. And on top of that, we would like to also thank you very much for providing us a specific chapter on TDR country profile for Turkey. So we received this as an early New Year gift. So thank you very much for this. Thanks a lot. And as now the year comes to the close and a new one is beginning. May this season bring moments of calm, gratitude, and renewed energy for the year ahead for all of us. And wishing you also a peaceful holiday season and a bright new year. Thank you very much. Thanks a lot.
My pleasure, and very same to you. Happy holidays.
Happy holidays.
Thank you very much for the invitation.
Thank you so much.
Thank you.